As we've been talking about, it was a very volatile week in the markets last week, with the Dow Jones Industrials Index dropping nearly 5%. But stocks came roaring back from the coronavirus sell-off as the Nasdaq clinches record close. So are there still good values to be found? Joining me from Fort Lauderdale, Phil Davis, founder of PhilStockWorld.com and PSW Investments. Phil, great to see you. That's an awfully nice-looking background. I hope it's actually that sunny, but let's get into things with the markets.
Nice.
Can you tell me, are you surprised with the speed and the intensity to which the markets have rebounded?
Well, yeah, for sure I'm surprised. I mean, I thought we were very overboard at the beginning, and it's surprising to see that we whip right back. You know, you have the virus scare, which it was more like, okay, good, something's finally going to be a catalyst for a correction. But then all of a sudden, boom, we're right back to those overboard conditions again.
So what do you make, though, of that? I mean, what's driving that? And because I know you were a little cautious of these markets not too long ago.
I am, and I still am. I mean, one thing we were looking at was the PEG ratio, price and earnings over growth. And when that number starts getting high, that means that the price divided by the earnings, the PE ratio, divided by the actual growth percentages of the company, the higher that number gets, it means you're paying just tremendous amounts of money for growth. And that number is hitting 4. And 4 is compared to a historical 1.25 average. So we're like 3 times value too high for the growth and the earnings that are showing up on the books. But part of that reason is just because money's got nowhere to go. Where are you going to put your money? Housing is still a train wreck. Bonds are completely useless. They don't pay you enough money. And of course, the bank doesn't give you any money for putting money in it. So you defensively end up trying to find stocks to put your money into.
And we've seen, well, you know, you were mentioning this in the break, and I hope it's okay if I mention it. We've seen a lot of money going into a lot of hot stocks lately, like Tesla. You were on the other side of that today, though.
Yesterday, not today.
Oh.
Well, we were. I mean, we woke up on the other side. Yeah, yes. Hey, look, it was the stupidest thing I've ever seen. The stock went up like crazy, and yesterday we saw the opportunity to sell the $1,000 call. So, you know, somebody was going to pay. Somebody paid us $120 to buy the March $1,000 calls from us. So our bet is just Tesla's not going to be higher than 1120 in March, which may have seemed scary yesterday, but today it's like, you know, it was a complete wipeout in one day. It was ridiculous.
Which is why you're smiling right now.
That's what we do, though. We're fundamental traders. We take advantage of that kind of stuff. That's what we use options for, to take advantage of those situations.
All right, well, let's talk about some of those strategies then, because the people, of course, who are watching want to know what specifically you're looking at right now. So I know that you've had an interesting play with a short play on a China ETF. So tell me a bit about what's going on with this and where you see it going.
Well, that one's old. I wouldn't really focus on that because that's from back 2 weeks ago when the virus first started coming out and we were watching the early trends. I said, you know what, guys, we want to short the market, and just in case this virus turns out to be a thing, China was also overbought like the U.S., and I said this could be a great catalyst to take the Chinese markets down. So right before their holiday started, we shorted the Chinese markets using FXP, which is the ultra-short ETF on China. And that just worked out tremendously well, obviously, unfortunately, because the virus was pretty bad. And the Chinese markets tanked, and especially early this week when they went down like 7.5% in one day, we cleaned up on the trade. But that was just a hedge, you know, against our general positions.
So tell me about, if we look forward then in terms of where you see some value right now, IMAX is on your radar.
Right. Well, then the point is, you know, we're really fundamentalists. So for the Money Talk portfolio, we're adding 2 new trades to that. And one is going to be IMAX. And because IMAX, it's definitely bad for the company. I mean, they're big in China. The Chinese New Year was a wipeout. Nobody went to the movies. Nobody went anywhere. Half the country's on lockdown. And even afterwards, I don't think a lot of people would be rushing out to the movie theater to sit next to somebody who's coughing. So what we thought is we could grab it now while it's cheap. And the trade idea we had for IMAX is to sell 10 of the September 18 puts for $250, because frankly, that's net $15.50. That's a really good price for IMAX. Then we buy 20. We use that $2,500 that we collect selling the puts, and we use it to buy 20 of the September 15-20 spreads for $2. So that's $4,000 minus $2,500 for the puts that we sell is a net of $1,500 on the $10,000 spread. So, that's a fantastic trade for us. If IMAX gets back to 20, we're going to make $8,500, which is 566% in 8 months. Those are the kind of trades we like to get into.
Now, let me tell you, Phil, I always ask this, my standard question. If the trade doesn't work out the way you want, what happens?
If the trade doesn't work out the way you want, you own 1,000 shares of IMAX at $18 because of the puts.
Yeah.
Plus the $1,500 you lost. So really net $1,950.
Yeah, but at that point, you're also saying, too, that's great value. You're going to hang on to that for a while because you like what it is.
Still like the stock. Long term, still like it. Yep.
Yeah. Let's get into another one here.
That's what we like. When the worst case is owning a stock we like anyway. It's the best way to play it.
Yeah, and I know people who've been watching us for a long time should know that because that's, again, the worst case scenario is you just end up owning a stock that you think has great long-term prospects. Let me ask you about another play that you have, Freeport-McMoRan. What are you seeing here?
Well, this goes back to your first guest who was talking about copper is way too low and gold should be a good value all year long. That's what Freeport-McMoRan does. They do copper and gold mining. Probably about 40% gold and 60% copper is about the mix of the company. Copper got ridiculously cheap. And again, why is it cheap? The China crisis. Is the China crisis going to go on for 2 years? No, it's not. It's going to be over. It's a flu. It's going to be over pretty much by the springtime. So it's a short-term thing, maybe 3 months to play out at the most. And then from then, things go back to normal more or less, and copper should be rising. We even took futures bets on copper at $2.50. It was crazy cheap. Like your guy was saying, he thinks $3 to $3.25 is about the right price for copper. And we're talking $2.50 right now, so it's a great play.
All right, let's just, I'm not sure if we can...
And then Freeport is
sorry, I was going to say, just linear for a second, Phil. We're just going to bring up the board so people can see the Freeport-McMoRan play, and maybe just take us through it in terms of what you see.
Sure, to summarize it, it's very similar to IMAX, but in this case, we're selling the $12 puts also for $2.50 though, because it's very volatile. So they have a lot of very expensive margins. Very expensive options. Sorry, very expensive options. So we're selling 10 of the $12 puts for $2.50. That's a net entry of $9.50. That is crazy low. And then we're buying 20 of the 10-15 bull call spreads, and that's netting for $2. So it's exactly the same ratios as we're doing with IMAX. It's going to be a net $1,500 trade. $8,500 potential payout if FCX is back over 15, and that's a 566% gain. But this one, unfortunately, will take 2 whole years to make 566%, which again, I don't mind. And the worst case scenario, owning 1,000 shares of FCX at $13.50 because it's 12 plus assuming you lose the entire 1,500 you put in.
Now, let me ask you, though, too, because, you mentioned this one as more of a, you see as like a, it could be I think you said at the beginning a 3-month play, but you said two years to get that big 500% payout, which, again, is a fantastic number to get to after 2 years. What is the, is there any downside to this, perhaps, though, if, in terms of holding Freeport, if, there's a global downturn and, you start to see that play out a bit?
Well, I mean, of course, obviously in a recession, it's like anything like Alcoa or anybody else or Arconic, whatever they call themselves these days. Any kind of commodity stock like that, if you get into a big global recession, obviously that's not good. But you can also pull the plug. These aren't plays where you're trapped in them. You can pull the plug anytime you want. You can take a small loss. The 3 trades that we started with 3 months ago when we started the new money to our portfolio, those are up 8.5% in 3 months. So that's pacing at 32% per year on our first 3 trades. And that was only using a teeny tiny amount of buying power for the whole portfolio. So now we're adding 2 more, and actually these 5 trades now that are in the money portfolio will make something in the neighborhood of $40,000 if they go well over the next 2 years. So it's just a question of just being intelligent. And again, the worst case scenario each time, we'll end up owning a bunch of really good stocks at really good prices. And yeah, if the whole market tanks and we choose not to exit the trades, we'll be holding these for a while.
Phil,
But, you know, I mean, that's what I want to do. I want to hold value stocks at low prices. That's my goal always.
yeah, no, I got it. Let me ask you. I've only got about a minute left, but but it's a good minute, so you've got time to tell me what you're thinking here. What is the one thing you think is so important in a market like this that investors should not do? Because it is, as you mentioned, a fully valued market. If you look at a lot of metrics, what is a very dangerous thing, in your opinion, to do right now?
Chasing. Chasing is the most dangerous thing in the world. Don't do it. Don't get into Tesla because Tesla's taking off. Don't get into Microsoft, Amazon. I don't care what it is. There's a channel for a stock. Anybody can look at a chart and see what a channel looks like. You buy stocks that are at the bottom of a channel that not just because they're at the bottom of the channel, but because they still have a good value. Any stock at the top of the channel, I don't care what kind of story you're trying to tell. Like people were saying Tesla 7,000 a couple of days ago. It doesn't matter. It's run its course. When you get into a stock after it just went up 100% in 6 months, even in a year, a stock went up 100% in a year, what you're saying is every single person who traded that stock for the past 5 years was an idiot, but now you see the value after it's up 100% over where they used to trade it. You know, you're not that smart. Nobody's that smart, and those people weren't that dumb.
Yeah.
There was a reason it was trading at a certain level for a long period of time. Do not chase stocks.
All right, that is clear, and that is great advice. Phil, thanks so much.
All right, thank you.
That is Phil Davis. He is founder of PhilStockWorld.com and PSW Investments. Thank you for joining us tonight. We hope to see you again next week, and have yourself a good few days.
The preceding paid commercial program was brought to you by TD Well,